Welcome to Breaking News to Trading Moves. And welcome to the debate. Imagine sitting right in front of your monitors. You have this multi-day swing trade perfectly mapped out. The logic is sound, the risk is completely defined, and your initial execution was flawless.
Right, a trader's dream scenario.
Exactly. But then, out of nowhere, a massive red candle prints on your screen. It wipes out a whole day's worth of unrealized profit in, literally mere seconds. Your pulse spikes. So, do you panic and hit the sell button to stop the bleeding? Or do you, sit on your hands and trust your original plan?
That is the million-dollar question, isn't it?
Literally, in some portfolios. We are examining some recent research on market mechanics and trading psychology that brings this exact dilemma right to the forefront. The debate today centers on how traders should actually manage active positions during periods of intense short-term volatility.
Right. And to lay our cards on the table, I'll be arguing that treating short-term adverse price action purely as noise until a hard invalidation level is hit, well, it's just an overly rigid approach. Rigidly ignoring intraday momentum means you risk missing vital, early warning signs of a failing thesis. And that leads to taking maximum defined losses when, frankly, a simple early adjustment could have protected your capital.
And I take the complete opposite stance. I hold the position that strict adherence to a predefined process, specifically honoring your original timeframes and intentionally ignoring the intraday noise of false breakouts, is absolutely required for long-term survival in the markets.
Well, let's get into it then.
Let me start by laying out why this rigid adherence to process is so vital. If you look closely at the text we're evaluating, you see that short-term market movement is rarely actual evidence of a poor analytical decision.
Rarely? That's a bold claim.
But it's backed up by the data. High-quality setups endure sharp, terrifying reversals all the time. They experience these targeted sweeps of liquidity. They suffer through temporary reactions to news headlines, and honestly, what is often purely emotional buying and selling from retail participants.
Sure, retail panic is real.
Right. And none of those mechanics mean a trader's original analysis was flawed. Often, it is just volatility doing exactly what volatility does. The material is clear. Judging a multi-day swing trade by a 15-minute candle is a critical process failure.
Well, I agree entirely that emotional reactions are detrimental to a portfolio. No one here is arguing for panic. But we really need to question the structural cost of that rigidity you're praising.
Cost? The cost is just having discipline.
No, the cost is capital. I challenge this binary classification where we label price action as either noise or new information. What the material categorizes as a temporary reaction often serves as a leading indicator of a broader breakdown in the asset.
But you can't know that in the moment.
You can get pretty close if you pay attention. If you wait patiently for a wide invalidation level to be reached on a daily chart, while you actively ignore the steady deterioration happening right in front of you on the lower time frames, you are actively choosing to absorb the maximum possible loss.
I see why you think that, but let me give you a different perspective on how we evaluate that incoming data. The framework we are exploring poses very objective questions for evaluating a trade while it's active.
Okay, like what?
Well, before reacting, a trader must ask, has the technical structure actually broken? Has the catalyst changed? Has the expected time horizon expired? Unless those objective conditions are met, the movement is simply noise. It's like commercial aviation.
Oh, here we go with the pilot metaphors.
It works perfectly. A pilot flying heavy aircraft through thick fog doesn't panic when the plane gets tossed around by turbulence. They look at their artificial horizon, they check their altimeter, and they trust the instruments in front of them.
Right, but hold on, let me finish the thought. The physical bumps in the air are just atmospheric noise. They do not mean the plane is falling out of the sky.
I'm sorry, but I just do not buy that exact analogy for financial markets. Let me push back on that airplane concept right now.
Go ahead.
In the air, turbulence doesn't change the laws of aerodynamics, right? But in trading, the turbulence is made of actual capital flow. It's made of aggressive algorithmic execution and real human panic. The bumps cost real money.
But they don't necessarily change the destination. They change the underlying structure.
Algorithmic moves and sudden headline reactions might be neatly labeled as noise after the fact by academics, but in the moment, they create real structural damage to the order book.
Let's pause there for a second because we are throwing around some technical concepts. For a listener who might not trade order flow every single day, when you say structural damage to the order book, what exactly are you picturing?
Absolutely. That's a fair question. So the order book is just the digital ledger of resting buy and sell orders at various prices. When I say structural damage, I mean those resting buy orders get violently pulled or executed.
Leaving a vacuum.
Exactly, leaving an absolute vacuum of demand. And if the demand vanishes, the asset falls. The turbulence actually alters the market psychology for the rest of the session. So I have to ask you, how can a trader objectively know a sharp move is merely a harmless liquidity sweep in the moment rather than the beginning of a genuine trend reversal? You're asking someone to ignore the very mechanics of how markets turn.
You know it's a liquidity sweep precisely by holding firm, letting the dust settle, and waiting for the close of the candle on your execution time frame.
So blind faith?
No, it's not blind faith, it's statistics. Let's break down the mechanics of a liquidity sweep, because the materials outline this beautifully. Say a stock is consolidating right above the $100 level.
Okay.
Retail participants logically place their stop-loss orders just below that, say at $99.90. Institutional algorithms know this resting liquidity sits exactly there. They need to buy a massive amount of shares, but if they just buy on the open market, they will push the price up way too fast.
Right, so they push it down first.
Exactly. They drive the price down to $99.85. This triggers all those retail stop losses, which are automatically converted to sell orders.
Which the institution then gobbles up?
You've got it. The institution absorbs all those sell orders to build their own massive long position at a great average price. And then the asset rallies to $105.
Sure, in a textbook scenario.
It happens constantly. If you exit because you fear a trend reversal during that initial drop, you are providing the exact liquidity the larger participant needed. You're making a decision based on the discomfort of the drop, not structural data. The market will test your stop placement specifically because the liquidity is sitting right there.
That is a compelling argument, and yeah, it happens like that frequently. But have you considered the other side of that coin? Discomfort often arises from a subconscious recognition of changing facts.
I'd call it just standard loss aversion.
Let's look at a false breakout scenario, though. Price pushes past a key resistance level, it traps momentum buyers who think it's going higher, and then it violently rejects downward. You might call that noise if your stop loss is miles away on a daily chart.
Because on a daily chart, it is noise.
But the reality of that rejection is that large participants just distributed into that strength.
Let's make sure we are clear on terms again. When you say they distributed into the strength, walk us through the mechanics of that.
Distribution is essentially institutional unloading. Large funds cannot just click a button and sell millions of shares without crashing the price, right?
Right, they need liquidity.
They need a frenzy of buyers to sell into. So when retail sees a breakout and rushes in to buy, the institutions use that buying pressure as a cover to quietly hand off their bags. They sell their inventory into the strength.
Okay, I follow the mechanic.
That is distribution. Once they are done selling, the demand dries up and the price collapses. That is an atmospheric turbulence. That is the plane losing an engine. By ignoring it, you are basically waiting for the crash to confirm the engine failure.
That's quite the dramatic framing.
It's accurate. If a trader sees that massive, high-volume rejection happening right in front of them, why should they cover their eyes and pretend it isn't happening just because their daily chart hasn't printed a red candle yet?
I am not convinced by that line of reasoning, because you're assuming the trader possesses perfect, real-time translation of what is happening.
Not perfect? Just observant?
But we know human beings are fallible. The moment you start trying to interpret a 15-minute rejection as an engine failure, you introduce discretionary panic into a system that requires statistical consistency.
Or you save yourself a massive drawdown.
Or you exit strong positions way too early, or you reverse your position at the absolute worst moment. The objective criteria, waiting for the structure to actually break on the time frame you planned for, protects you from your own fallibility.
But doesn't that willful blindness carry a heavier cost?
It isn't blindness, it is statistical discipline. Professional trading is not about looking right every minute of the day. It's about repeatable decisions based on defined risk.
Right, but
Over 100 executions, exiting early because you think you spotted intraday distribution degrades the statistical edge of your process. A good trade can lose and a bad trade can win. You cannot judge the process by avoiding one single loser.
okay, this brings up a crucial tension regarding time frame mismatch. You argue that a multi-day idea cannot be abandoned because of one weak intraday candle.
Correct.
On a theoretical level, sure. But let's examine the anatomy of a daily trend reversal. A daily chart doesn't just suddenly reverse out of nowhere. Every single daily trend reversal inherently begins on the 1-minute chart.
Well, obviously, time is linear.
Right. The sellers overwhelm the buyers for 60 seconds. That bleeds into the 5-minute chart, breaking the structure of higher highs and higher lows. Then it infects the 15-minute and finally the hourly.
And your point is?
The lower time frames always break first. By strictly adhering to the higher time frame and refusing to acknowledge the lower time frame's deterioration, you are willfully blinding yourself to the early clues.
Let me challenge that directly. Why wait for the daily structure to break when the intraday structure is screaming that the buyers have exhausted themselves? I'll tell you why. Because if you constantly monitor those lower time frames for early warnings, you risk entirely missing the exact moves you planned for. Think about the math of trade expectancy.
Go on, run the math.
Let's say you build a plan for a 3-to-1 reward-to-risk ratio on a daily chart. You risk $1,000 to make $3,000.
Standard setup.
Right. Now, if you intervene early because the 5-minute chart looked heavy, you might only take a $300 loss. You feel brilliant. You save $700.
Capital preservation.
But here is the trap. You will also habitually cut your winners short before they mature, because every major multi-day winner will experience multiple 5-minute breakdowns along the way.
Not every winner, but yes, pullbacks happen.
You end up with a portfolio of small losses and tiny wins, which is a mathematical path to ruin. Return to the time frame that produced the idea. Do not let a short-term emotional response overrule a longer-term plan without genuine evidence.
I hear that, but I would frame it differently. Using the lower timeframes is about actively managing risk, not purely panicking. The argument isn't to stare at a 1-minute chart and sweat over every single tick.
It sure sounds like it sometimes.
The argument is that if the daily thesis relies on a certain sector catalyst and the intraday price action shows relentless high-volume distribution that defies that catalyst, you have new information.
You keep using that phrase, new information. But what exactly constitutes new information versus standard volatility?
I'll tell you, when the real-time feed of completed transactions, shows an overwhelming imbalance of aggressive sellers continually stepping into the market, pushing the price down without any bounce, that is the reality on the ground.
That's just temporary imbalance.
But the thesis is already weakening. You don't have to wait for your daily stop to be hit to acknowledge that reality. A strong process includes a willingness to accept uncertainty, yes, but it shouldn't demand a refusal to process real-time data. But what you call real-time data is often just the market seeking equilibrium. The text points out something critical here. There is often a gap between a trader's thesis and the market's timing.
Sure, timing is the hardest part.
Exactly. A good trading decision can look completely wrong for several hours before the market proves it right. Many traders judge themselves by what happens immediately after they enter. If price moves against them, they assume they made a mistake.
Which is a very human reaction.
Extremely human, but completely flawed. Short-term movement is not always evidence of the quality of the entry. Sometimes it is just a slow period before momentum arrives. To survive that, you must have a position size that allows for normal volatility. If you are agonizing over a 5-minute chart while trading a daily setup, your position size is likely too large.
That's fair.
That excessive size generates the anxiety you are then mislabeling as new information.
Position sizing is paramount. We completely agree there. If you are sweating, you are trading too large. But we really need to examine the psychological reality of enduring these drawdowns. We have to distinguish between patience and blind hope.
They're very different things.
Right. I acknowledge the strength of having a defined risk level. Absolutely. A hard stop prevents catastrophic ruin. But the line between patience and hope is much thinner than this rigid framework suggests.
How so?
Consider a scenario where a trader endures a sharp, immediate move against their position. They are now sitting in a drawdown, watching their screen bleed, waiting out a slow, agonizing period before momentum supposedly arrives. They are functionally enduring a period of hope.
I wouldn't call it hope if they are sticking to a predefined plan.
But they hope the original invalidation level holds. They hope the liquidity sweep is over. While their capital is tied up in a stagnant or deteriorating asset, there is an opportunity cost. How is passively absorbing that damage superior to active risk management?
It isn't hope if it is rooted in historical probability and a tested system. Blind hope says, oh, it will come back. That is an emotional plea to the market.
Right.
Disciplined patience says, the thesis remains valid, the risk is defined, and the market has not reached the level that proves me wrong. That framework successfully removes emotion from the outcome. It forces you to accept the risk you defined at the entry.
I get the theory behind it.
When you enter a trade, you are buying a probability. You pay for that probability with your defined risk. Trying to micromanage that cost after the fact, based on intraday noise, is a violation of the original contract you made with your own strategy.
But is it the optimal execution of capital allocation? Let's look at the efficiency of it. A more adaptable trader might recognize the early false breakout, read the tape, and exit the position for a fraction of the intended risk.
And then miss the move?
They wait for structural confirmation to re-enter. Instead of passively absorbing the drawdown, they maintain fluidity. They read the intraday clues, step aside, and re-engage when the higher time frame aligns with the lower time frame momentum. That isn't a lack of discipline. That is an advanced application of capital efficiency.
The reality of attempting to constantly time those exits and re-entries during normal intraday fluctuations usually results in a phenomenon known as being chopped up.
Walk the listeners through the chop.
Gladly. You take a small loss exiting early because the intraday momentum looked weak. 10 minutes later, the asset stabilizes, so you re-enter. An hour later, the market shakes you out again with another algorithmic sweep, so you take another small loss.
Well, if your timing is completely off, sure.
It happens to the best of them. By the time the actual planned move happens, you have compounded multiple small losses that equal or exceed your original defined risk. Worse, you are too emotionally exhausted to hold the real trade when it finally works.
That is a risk, yes.
This reinforces the core concept we are debating. One outcome does not prove the quality of the process. Surviving the intraday noise by doing absolutely nothing is often the highest form of discipline. Doing nothing is an active choice.
Doing nothing is an active choice, but it can also be an excuse for analytical paralysis. We have to acknowledge that corporate realities change during market hours.
If there's news, yes.
If a company or sector receives meaningful news mid-session, the expected time horizon and the technical structure are instantly challenged. If a trader says, I must wait for my daily invalidation level, while a sector-wide liquidation is happening on the tape, they are practicing dogma, not discipline.
I agree on the news front, though.
Right. New information is something that genuinely weakens or invalidates the thesis. And quite often that new information arrives in the form of relentless intraday order flow, relentless selling pressure that simply refuses to bounce.
If there is genuine news, like a regulatory announcement or an unexpected earnings pre-release, then the objective criteria of the process handles it. The process explicitly asks, has the catalyst changed?
Exactly.
If yes, the trader is authorized by their own process to exit or adjust. But what we are talking about here is price action without a visible catalyst. We are talking about the emotional order flow that happens between the major announcements. The market may challenge your timing, test your confidence, and temporarily move against a sound idea. Your job is to know when discomfort is normal and when the facts have actually changed.
And my contention remains that price action itself is a fact. The tape is the ultimate arbiter of truth in financial markets.
It's a very noisy arbiter.
But it's true. If the price action is heavily skewed toward distribution, even without a visible news catalyst, the facts have changed. Someone knows something, or a large fund is unwinding a massive position. Either way, the supply and demand mechanics that formed your original thesis are no longer present.
Expecting a daily chart setup to magically hold when the intraday liquidity is completely absent is a recipe for maximum drawdown.
As we bring these perspectives together, my stance remains that adhering strictly to a predefined process, maintaining defined risk, and honoring the original time frame is the most reliable way to survive intraday volatility.
It's certainly a safe fallback.
Without these anchors, a trader is at the mercy of their own emotional errors, treating every single candle as a verdict on their ability. The best traders are not always the ones who look the smartest during the intraday session or the ones who dodge every minor dip. They are often the ones who stay calm, follow their initial plan, and let the full trade play out without constant intervention.
And I maintain that flexibility and reading early intraday clues serve as vital tools for capital preservation. A rigid refusal to adapt until a hard stop is violently hit represents an incomplete strategy.
Even if adapting means overtrading?
It doesn't have to mean overtrading. Recognizing when noise transitions into genuine structural failure requires active observation, not passive endurance. You cannot just cover your eyes and trust the daily chart when the intraday structure is collapsing right in front of you.
Well, we do find common ground on a very vital concept drawn from the materials, though. Both of our perspectives demand rigor.
Oh, definitely.
We both agree that discomfort alone is never a valid trading signal. Whether you adapt early based on reading the tape or hold to the absolute bitter end based on a wider structure, a well-defined process with a clear, logical reason for entry is an absolute necessity for anyone participating in these markets.
Absolutely. Without a defined reason for entry, and without a clear understanding of what invalidates that entry, you are just gambling. You aren't participating in a process at all.
The tension in trading will always be balancing the discipline required to let a setup fully develop against the awareness needed to recognize when the facts have actually changed. The research we review today offers a compelling lens for this challenge.
There is definitely a lot more to explore in this material regarding market microstructure.
For sure. But it ultimately falls to the individual market participant to determine where the line between disciplined patience and stubbornness truly lies. The next time you find yourself staring at a chaotic 15-minute candle, wiping out your gains, you have to ask yourself, are you flying by your instruments or are you just feeling the bumps?